Okay, so in the previous example I talked about like arbitraging across two different exchanges like Binance and FTX with Bitcoin and Ethereum. So we know that Bitcoin on Binance and Bitcoin on FTX are the exact same asset, and Ethereum's the same asset on both sides. But how about if we have large portfolios? So a portfolio of investments can be made up of different types of assets like stocks, bonds, cryptocurrencies, commodities, all of different weights. So how do we price all these different large portfolios, right? Because they have all these different underlying assets underneath. So the single factor asset arbitrage pricing theory model actually helps us do this. Okay, it states that portfolios with the same beta should have the same expected return. So fundamentally, what this means is that we don't really care about what those portfolios contain, but we care what the overall risk relationship with the common risk factor that a portfolio has, and that's how we price it. Okay, so we can have portfolio A that consists of a bunch of, let's say, stocks and bonds, and we can portfolio B, which is made up of cryptocurrencies and commodities. And somehow or the other, these two different portfolios have different weights, but they have different constituents of the portfolio. But when we actually run a regression or look at the relationship with the common risk factor, which let's say is the S&P 500, it is the same beta. So portfolio A and portfolio B, we don't really care what's the underlying assets within the portfolio, but because they have the same beta with a common risk factor, which is, let's call it the S&P 500, they should have the same expected return and therefore the same price. Because otherwise, okay, if these two portfolios have different expected returns, but the same beta, we can arb it, right, by short selling B and buying A. So that's what we're saying over here, okay, is that we have the return and with the factor. And what we're actually saying is that A and B, which have the same exposure to the risk factor, okay, if they're different, right, that means one can actually arbitrage, and actually the arbitrage value is the gap between the two lines. So we also want to state that the expected return with the beta relationship between those portfolios and that common risk factor is linear. Okay, so if you look at this graph over here, what do we see? The x-axis, we have the risk factor, the beta, right, the relationship with the risk factor, and on the y-axis, we have the expected return. Okay, so as we go from the axis from 0 to 1, what we're saying is that the coefficient to the risk factor goes from 0 to 0.5 to 1. Okay, so if it goes up to 1, this is like the market portfolio, this is the risk-free rate. So if we actually look at the market portfolio, we're saying that it's an expected return of, let's say, 10%. Okay, if we are over here, we're actually saying that we have a risk exposure of 0.5. That actually means that if you're on the line, we have a return of 7. Okay, if we have no exposure to the risk factor at all, which is 0, we have a return of 4%, which is the risk-free rate. Okay, so what we're saying over here, if we have two portfolios, A and B is not on the line, that means we can arbitrage by short selling B and buying A. Okay, because A is a portfolio of equal weights in M and RF, because we can see it by the 0.5 over here. Okay, so this is basically a more graphical representation of what we see over here, all right, to indicate to you that A and B, if they have the same risk exposure, they should have the same expected return. If they do not have the same, where A is having 7 and B is having 6, then we can arbitrage this. Okay, essentially, you could say that one can actually short sell B and actually buy A, okay, and make that 1% profit, which is an arbitrage profit. So let's look at tracking portfolios and arbitrage, right? Again, how do we capture alpha? So what is alpha? Alpha is considered to be the arbitrage profit. Okay, so let's look at this example. We have the excess return on the portfolio is 0.04 plus 1.4 times the risk premium. Okay, we have this chart over here where you have expected return on y-axis and the relationship to risk factor, which is on the x-axis. Okay, and we have the RF that's here. One, this is the S&P 500, which returns 4%, and this is where we have 1.4. Okay, which means this is where our portfolio sits, right? So what we're actually saying over here is that the beta of a portfolio is 1.4, and the alpha is actually 4%. So what we've actually done over here, we actually constructed T, which is this portfolio, where it's 140% in S&P 500 and negative 40% in T-bills. So if we actually move up this line, we know that when we're actually at this point, we're fully invested in the risk-free rate and not invested at all in the market portfolio, which is S&P. As we move up this line, our weight on the risk-free asset goes to 0 as we're up here, and our weight in S&P 500 becomes higher and goes up to 1. If we actually go beyond the S&P and up this zone, this actually means we actually start to go negative on the risk-free asset, and we're actually leveraging to actually buy the S&P 500, which is what we're describing here. At T, we are 140% S&P 500, and to go 140%, we're actually taking negative 40% in T-bills. That's actually how we get that formula over here. So what happens is that we can actually buy portfolio P and actually sell T. Okay, and this is how we actually create the arbitrage profit, right? We created it because basically we actually look at this, because we actually saying over here is that these two essentially have the same risk exposure, right? But we can see P is up here and T is over here. So there's that gap. So there's 4% alpha that we can generate, right? So this is actually the return from portfolio T, and this is the return from portfolio P. So basically what we've done, we've actually arbitraged by buying P, which is this equation here, and then selling T, which is over here, and we'll average profit of 4%, which actually captures this gap in between. So we're saying that these two portfolios had the same risk exposure, but different expected returns, so we actually get an arbitrage profit of 4%. So this is when the target is a large portfolio with unsystematic risk that equals to 0. So what I want to talk about now is about the relationship between the arbitrage pricing theory and the security market line. Okay, so with the one factor APT, right, we have the expected return equals to lambda naught plus lambda 1 plus times by beta 1. So we're saying that this is a single risk factor and lambda's relationship between that asset and that single risk factor. Okay, if we talk about a risk-free return, that means there's beta equals to 0. Right? So that means that we take the same formula, we set beta equals to 0 because basically this is about the risk-free return. So we see that lambda naught equals to the risk-free rate. Okay, because lambda 1 times a beta of 0 just becomes 0, so lambda naught equals to RF. So when the market risk factor is a single factor, so this is like a CAPM, right? So basically what happens, the arbitrage pricing theory, okay, is more generalized because you can have multiple risk factors and different types of risk factors. You're not just like restricted to market risk. But let's say if we look at the arbitrage pricing theory that has market risk as a single factor, then if the market portfolio, you have a beta of 1, then what we actually see, the expected return on the market equals to RF plus lambda 1 equals to 1, which means that lambda 1 is the market risk premium, right? So we see over here that a one factor as arbitrage APT, okay, where that one factor is the market risk factor, gives us this equation, which is expected return equals to the risk-free rate plus beta times the market risk premium. So this looks a lot like the security market line, and this looks a lot like the CAPM, whereby you're compensated for your taking on factor risk. Okay, so what we're actually trying to do over here, we actually introduce you different types of theories like the CAPM, arbitrage pricing theory, multi-factor models, and we're trying to actually show you that the arbitrage pricing theory is basically a model that actually is more generalized than the CAPM, which focuses on just the market as a single risk factor, but it allows for multiple factors in the pricing model instead. But if we actually bring it down to a single factor and look at a single factor as the market risk, it looks a lot like it's the security market line. So what is the difference between the CAPM and APT, right? So what happens is about the fact that the CAPM, there's a risk-return trade-off. The CAPM focuses on the factors on a single market portfolio. The CAPM has very strong conditions, strong assumptions, okay? And the CAPM has a very unequivocal statement that the expected return in the beta relationship is for all assets. Okay, so some can say that the capital asset pricing model was the foundation, okay, for pricing theory, but it was very strict. Whereas the arbitrage pricing theory is much more relaxed. It says there is no arbitrage condition based on the law of one price, right? That is not just like it's not just about a single risk factor, which is the market portfolio, but a set of factors. Okay, it also says that you cannot route a violation of the relationship for any particular asset, and that APT doesn't specify a factor at all. It says the factors can be anything, it can be like GDP, it can be like unemployment. It's not just the market. So the APT and the CAPM is a stricter version. The APT is a more generalized version, which is more pragmatic and more practical, right? But if we actually use the APT and say there's only a single market risk factor, it looks a lot more like the CAPM when you look at the calculations. So this is just a theory between the CAPM and the APT.